Tons of data new in. We are continuing to see some good news on the commodity side and the raw material side. Great news for lumber, not so great news for steel, or really not much new news for steel, which we'll cover today. We're also going to talk about a few things that everyone needs to be monitoring now that are starting to emerge around some potential supply chain disruptions that could affect your profitability and your estimating on projects going forward. Welcome to the PioneerCast. I'm Dwayne Abels, founder and president of Pioneer IQ. Hope over the course of the next 15 to 20 minutes, you're able to pick up some key insights on how to develop your leaders, how to build your business, and how to forecast and monitor your markets. We've been working through an episode, or a series rather, that is all about 2021, the year of transition. Simply put, we've all gone through and experienced what happened in 2020, went through an election cycle, and have all types of new disruptions that are driving opportunities and in turn changing the landscape of most of our markets. What we've been monitoring over the last several months is the significant need for buyers of design and construction services needing to reassess how their clients and their markets are being affected, redevelop their plans, and redeploy different resources and even teams, some of which may include you, to be able to better serve their clients, modify facilities, and build new ones. To help us with the raw material and the commodity forecasting, I'm bringing back a trusted friend, Keith Prather. Keith, thanks for joining us. I am a bit nervous and excited about what we're going to talk about today.
Yeah, it could be a little bit of a roller coaster, to be honest. We'll see as we get into it.
So there are very few times where I'm going to text or email you or send you a message early in the morning or late in the evening. When I do, it's typically around a phone call from a contractor really concerned about a certain commodity, lumber being a very popular one, steel being a very popular one. But man, there is a lot of confusion and a lot of fear even around some of the commodities. And so I'm excited for you to give us kind of an update on where you see things moving, and then also anxious to hear what you mean by some new potential supply chain disruptions to be monitoring or slightly concerned about as we move forward.
Absolutely. So why don't we just start with lumber? You know, you and I have had this question now for about the last 18 months, and lumber supplies, during the COVID outbreak, were really challenging. A lot of lumber mills had to shut down. A lot of, staff had to be quarantined. And so we really got behind. And you guys all know the story, but, you and I have been getting this question now, and people wanting to know when are lumber prices going to come down. Well, we had a May peak, and we see that across most commodity classes, if you will. But we're down about 210% from that May peak. They're still about 44% higher than they were during the lockdown period last year, and about 52% higher than they were versus the pre-pandemic period we saw in 2019. So bottom line is lumber prices are coming down. We think they continue to come down for a little bit longer. We don't think that they're going to get back to those pre-19 levels, only because I think there's a tremendous amount of demand. And we see that in some of the new housing data. Even though permits for new home construction is a little bit sluggish right now, at least over the last month or so, it's a real volatile number. It changes month over month, and we could see that come right back up. The more stable number that we like, though, are housing starts. So we're actually putting, boots on the ground, and we're actually, starting projects. We see new housing starts right now at about 1.6 million, which is toward the top of a 15-year range. We've got to go back to about 2005, 2006 to be able to see housing starts in the same volumes as we're cranking them out now. So lots of good indicators there. The demand's going to stay strong, and now finally lumber supplies are catching up.
Okay, so I'm going to put you on the spot, Keith. This is the $1 million, well, maybe for many, the multi-million-dollar question. When do you think retail prices are going to start to better align with the falling commodity prices for lumber?
I think there's a lot of different factors, and I'm not going to go into all of them right here, but I do think by the end of Q3 and kind of into Q4, you're going to start to see retail lumber prices start to come down. And then by Q1 of next year, we're definitely going to see them lower. everything from supply catching up to just, families getting back into a routine with their kids going back to school, into what we'll call the sort of the new normal, if you will. A lot of the projects, a lot of the things that we were using to keep to keep ourselves busy and, to reduce idle time, that's going to be out. That's going to be out the window now. And so we're going to be focused on other things. And so I think that's going to help lumber supplies increase and prices will come down.
Excellent. All right, so let's switch to the next topic. The one that we get asked about a lot is also steel. So we're thinking about steel and where we've seen it. Tell me it's going down, Keith. What's happening here?
Man, I would love to. I just can't yet. Steel price is still at all-time highs. You and I have had many conversations with clients about this, and I'll let you tell the steel trust story here in a second. But we just don't see a lot of the key ingredients that go into making steel really improving anytime soon. And a lot of it's just because of global supply chain disruption. It's not being able to find enough ships, not to be able to find enough, truck drivers and people to be able to move a lot of the commodities around. China has started dumping a lot of commodity products on the open market inside China to try and push prices down. So they're dumping steel, they're dumping copper, mostly in their domestic markets, and it just still really has not made a global dent in some of these prices. We know Australia is having all kinds of disruptions, so we've got limitations on the amount of iron ore coming out of the country, coking coal. Again, just lots of challenges. And then scrap metal is one of the key components, and we're not getting the usual scrap metal we would when we tear down a building or we go tear up a highway and take the rebar out. And so we're not adding to a lot of scrap metal domestically, but on a global basis, we're still not scrapping things like maritime ships, like we were prior to the pandemic. We've needed every ship we could keep our hands on. And so maritime companies are keeping assets that are much older than they should be. And so bottom line is we just can't get enough inputs into the steel industry to be able to let it catch up to where it should be. Yeah.
You brought up trusses, right? So we are hearing that a lot. I mean, we've heard stories on back orders that could take 6, 9, 12 months to get in. Talk us through some specifics here that are being affected by the steel market and some of the radical shifts that are taking place.
Yeah, those of you who have kind of been with us through the PioneerCast in the past have seen this producer price index chart. I've used it many times. So we've updated it with the latest data. And what you've got is a class of commodities here, a class of raw materials and finished products. They're just seeing kind of a super surge in price still. So in that red box there, Dwayne, we've got flanges and unions and, steel pipe and tube, copper, pipe and tube, plastic pipes, fittings and unions, anything going into the plumbing sector. And you're seeing it, not only month over month, super expensive. I mean, or, seeing prices increase, but on a year-over-year basis, we're just unbelievable, double digits across the board. Look at copper and copper-based alloy pipe and tube. I mean, up almost 100%. Even plastic pipes, anything PVC, just because of resin shortages right now, up nearly 50%. Now, again, the most important part of this whole talk is what happens in the future. And so we think, again, that it's going to take steel a little bit to catch up. We're probably looking at sometime early next year before steel can really start to recover and we really start to see ample supplies. But in the copper complex, I think it'll recover a little bit quicker. But plastics like resins, I'm hearing of backlogs on resins now that are stretching 6 months and further. So barring any hurricanes coming up the Gulf, it's still going to take the resin industry a little while to recover.
Yeah, you bring up a great point there. As you're talking and I'm looking at this chart here, I just don't know how in the world it's possible for an estimating department to have a legitimate handle on some of these commodity prices. I mean, how in the world do you predict a 19% increase in copper over a 30-day period? And then you look out over a year and it's 100% increase. It's putting a lot of pressure on the CFOs and on the estimating departments inside these construction companies.
Yeah, a lot of those folks are getting about as gray as I am, right? Like overnight. Yeah, it's a moving target. It really is. And there's a reason why you and I watch this stuff on a monthly basis and report out to some clients because, it is just constantly fluctuating. And there's so many different factors worldwide that are creating these disruptions that are pushing prices up. So best advice I would have for them is just really stay close to those suppliers. I know that we have clients, Dwayne, you and I, that are getting requests from some of their bigger contractors, asking them
Yeah.
for specific details on what's happening in their supply chains, how stable, how in cycle they are, what do their suppliers look like. So if I'm buying steel, I might ask my
Mhm.
steel supplier what their conditions look like, but then I may also ask them to tell us what their supplier conditions look like. So to go 2 or 3 different layers into the supply chain to help understand the story. That's probably the best advice we can give them right now.
So the third biggest topic that seems to surface is petroleum cost, how it's affecting our job sites, and obviously fuel and vehicles and machinery it takes to do projects, but also how it's affecting geographic markets, rig counts, etc. Where do we stand on petroleum coming out of Q2 and into Q3?
Yeah, Dwayne, and beyond just the 11 million people that kind of work in that sector across the country, and the tremendous amount of GDP it cranks out, and especially the southern states, it is critical in just understanding overall inflationary pressure in the United States. I mean, every company, every individual, every consumer gets impacted by what happens in the petroleum sector. So right now, crude oil prices are about 12% lower than they were in July. So prices are coming down, but we're still about 39% higher year to date and about 52% higher year over year. We don't have the same number of rigs cranking out oil. It's just that global demand is so low still right now. I'm sorry, global demand is starting to grow. We don't have enough rigs, going. So it's the opposite. And we start to see prices increasing. So total U.S. oil and gas counts for rigs right now, at least as of the last update, we're running somewhere right around 500 active units. That compares to being at about 1,000 in 2019. So we are still not creating the kind of production and output that we had prior to the pandemic, but demand is starting to come up. So the chart on the right is from the EIA, and it just real quick, if you just look at the blue line, you can kind of see production, and the gold line is world consumption. And so you can see kind of through Q3 of this year, the consumption still outpaces global production, and that's why oil prices are still high. But they do come together. By the end of the year, you start to see production match consumption, and then we start to kind of grow out of it all the way through 2022. So the bottom line is that we're going to start to see inventory start to build a little bit, and that's going to put a little pressure on further investment and further construction. But still, if you're the EIA and you look back and let your eyes kind of follow back to where it was in 2019, the EIA expects production to be back where it was sometime mid 2022.
Well,
So
that'd be interesting to see how it affects some of these communities in West Texas or North Dakota or Colorado, Oklahoma. A lot of those communities will be excited to see some of that rig count kick back up, and then in turn provide more funds into their communities. That's good news.
absolutely. And like you said, the ripple effect there, you just get more spending for schools, just commercial real estate, housing, residential. I mean, it's just almost like the tide that lifts all ships. So.
Well, there's a lot of information that we've covered. There's a lot of summaries that we're trying to make. If you could help us package this into a couple of key points that are critical for executives of design and construction companies as we walk away from this topic today.
Yeah, a lot of bullet points here. I mean, the bottom line is that some prices are starting to soften for commodities, and some are staying high. We know there's a little bit of slowing economically across Europe, China, a little bit of Southeast Asia because of Delta. And the US is also starting to see a little bit of a deceleration coming off of where we were in what was maybe the peak sometime in May and June. But we just got the latest inflationary data, and there's some moderation of inflation happening. So prices are still high, but we're sort of decelerating and kind of coming off of those high levels. The last thing to watch, though, as you and I have talked about, we've just got some severe disruptions starting to happen across Southeast Asia. A number of those small countries that we count on for a lot of products, especially a lot of construction materials, are going through some really tough times with Delta. They've got vaccination rates below 10%, and we're seeing ports get shut down. Businesses are temporarily shutting down, and these are unexpected disruptions. 2 months ago, we weren't looking at this, and this wasn't even on our radar. The disruption is going to last, Dwayne. I mean, it's going to go through the end of Q3, well into Q4, and some of those markets may not recover wholeheartedly until early next year. So unfortunately, I mean, the bad news is that some of these disruptions are going to get a little bit worse before they get better. So anything sourced domestically like lumber, we should see inflationary pressure continue to come down. Anything that we rely on some foreign sourcing for, I think we may see inflationary prices, and prices are going to remain high for a little while longer.
Wow. So at the end of each of these PioneerCasts, we like to try to give you a couple of key things that we think are really critical for you to do walking away from the conversation. Number one, we would really encourage you to dig into some of your partnerships within your supply chain, understand what they're seeing, understand what they think might happen over the short and midterm to help better equip your team with what to expect. Secondly, I would sincerely extend some grace to your estimating department. Those guys and gals are having to deal with a lot of fluctuation, which I know you're aware of, but it's putting them in a very tough situation to be able to forecast and predict and to set expectations for what clients should be expecting going forward. So again, dig further into the data, provide them with as much insights, and help build their confidence in what they're doing marching forward, because there's a ton of risk and a lot of fluctuation that they're having to deal with. Obviously, with this even particular piece of data, changing, needs changing. Everybody's got so much to analyze and to look at, and we would just encourage you to lead on, because people need you now more so than ever.